All right. What is up, traders? What's up, tycoons? Super excited for today's video. We're going to go over ZIM, okay? Ticker symbol ZIM. Now, ZIM integrated shipping investors endured a painful April as it fell toward its December 2022 lows. However, dip buyers have returned to help stanch a further decline. The U.S. economy has weathered its recent headwinds well. China could also emerge stronger in the second half, arguing well for a more robust recovery. Investors have become likely bailed out as ZIM's forward dividend yields have been slashed to 2.4%. Therefore, the hangover from these investors could be over for now. Investors anticipating a more robust recovery in the second half of fiscal year 2023 should find the current levels enticing. Now, we're going to go over ZIM in today's video. We're also going to give a shout out to today's sponsor, Simply Wall Street, and we're going to use that platform to dive into ZIM a little bit more, all right, and really key in on some of the nice factors and different things, okay? If you don't understand fundamental analysis, Simply Wall Street does a really good job of presenting it for you guys very concisely, and they also give you some nice visual graphs as well to help you understand the information. So shout out to them. We'll go into them further later. Before we move forward, of course, I'm not a registered financial advisor. Okay, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. Trading in stocks, bonds, commodities, and crypto involve a significant risk of loss and is not suitable for all investors. So be sure to read through the full disclaimer, and we'll go ahead and get into the video now and start going over ZIM some more. Container shipping company ZIM Integrated Shipping, ticker symbol ZIM, is slated to report its first quarter earnings release on May 22nd. Investors will likely assess the impact on ZIM's forward dividend yields as Wall Street estimates have already marked down ZIM's forward dividend yield to just 2.4%. After a highly remarkable year in 2022, as ZIM posted a high of nearly 50% in dividend yields, investors are reminded that good times often don't last forward in cyclical industries like container shipping. However, ZIM's plump yield significantly mitigated the impact of the collapse in ZIM's price action since the March update. However, income investors will likely not bolster ZIM in the near term, given its much lower expected forward yield. Therefore, investors looking to buy ZIM's recent dips must be confident of a second half recovery in the company's operating performance. In addition, there are signs of optimism in the U.S. economy, suggesting we could avoid a debilitating severe recession. While a recession should not be ruled out, ZIM's significant collapse from its highs in 2022 should have reflected the worst of the down cycle in container shipping. Analyst estimates for the S&P 500 showed that they underestimated the earnings resilience of companies that have reported. Blended estimates for Q1 earnings show a decline of 3.3% compared to the initial estimate of a 7.9% decline. Moreover, forward earnings estimates suggest a growth inflection in Q3 and Q4, suggesting that Wall Street has a good outlook on this company. Now, moreover, Edward Yardeni also provided several economic data points that highlight why his thesis of a soft landing is looking increasingly likely. Therefore, the U.S. economy doesn't look like falling further into a severe downturn, which should provide support for consumer spending, which has remained surprisingly robust. Notwithstanding, China's economic recovery has hit some recent speed bumps in April as the momentum from the first quarter wore off. Despite that, China's recovery remains predicted on a more robust second half growth story, indicating that investors should avoid relying on a single month or quarter's data point to draw a conclusion. Moreover, supply chain data suggests that China's smartphone vendors expected a sequential recovery in the second quarter. As such, it could indicate that the inventory digestion and weak consumer demand could have bottomed out in Q1, helping bolster the thesis of an H2 CY 2023 growth inflection. With that in mind, what about the outlook for the container shipping industry so far? Admittedly, all right, the signs remain weak as several recent data points indicate that the downturn in container shipping might not be over. Freightos Global Container Freight Index resumed its downward slide over the past 4 weeks after a momentary recovery in April. Industry sources suggest that the recovery is based on general rate increases or GRI. However, a potential rate war could emerge, hurt by the double whammy of overcapacity and weak demand. However, some analysts regard the recent slide as not a new phenomenon, but an expected normalization. We'll dive a little bit deeper into ZIM real quick. All right, and we'll talk about some of the recent commentary from shipping peers is still optimistic. Maersk expects the downstream inventory adjustments to conclude by the end of the second quarter. However, trade volumes are still contracting. The leading container shipping company also warned that the move towards inventory normalization is not consistent. However, Hapag-Lloyd seems to be optimistic. The company expects a stronger consumption and an uptick in demand. However, the recovery is expected to lean towards the end of the second quarter or early in the third quarter. Therefore, investors must decide whether they think ZIM could participate in a second half recovery. It's likely too early to determine the data points, which remain dynamic and dependent on the progress of the economic recovery. Moreover, Wall Street estimates are not optimistic about ZIM. The company is projected to deliver significant revenue declines through Q4 of 2023 before bottoming out. As such, it's expected to affect ZIM's adjusted EPS markedly for fiscal year 2023, suggesting why analysts have slashed their forward dividend estimates for the company. Accordingly, the company is expected to post an adjusted EPS of negative 254 for fiscal year 2023. Also, ZIM is not likely to report positive adjusted earnings through the forecast period to fiscal year 2025. In contrast, Maersk is expected to remain profitable through fiscal year 2025 despite the steep earnings decline, and therefore is expected to weather the downturn more favorably. As such, I assess that Wall Street has likely penciled in highly pessimistic estimates for ZIM and lowered the bar for the company. Therefore, it probably augurs well for the company if it executes better than expected. However, the critical question is whether buyers have returned to help stanch the downside after its previous dividend payout. So, ZIM is a stock that I've had in the 50K portfolio challenge, the dividend and wheel strategy portfolio. And this stock has been in there for a very long time. Now, I am down on the shares, okay, but the dividend that it was paying, and I got into the ZIM back in 2022, was really, really significant, okay, and really helped bolster and actually keep me net green on the stock, along with selling covered calls and selling cash secured puts. And we can take a look here, and we can see the dramatic drop in the price of ZIM, all right, from over $84 all the way down to about $17 currently. And if you take a look, even recently, it was trading up here in the 24s and 25s and has already seen another dramatic drop. So, this is this is what we're saying, basically, Wall Street penciling in highly pessimistic estimates and lowering the bar for the company. You're seeing that being reflected in the share price. Now, they're going to be reporting earnings on Monday. And based on how their earnings look and what the stock price does, and if they announce any dividend cuts or anything like that, all right, it will determine if I end up cutting that out of the 50K portfolio challenge portfolio. And if not, if they don't really cut the dividend, or it's not by too much of a significant amount, then maybe I'll keep it in there. But I've had that one for a while, and I've always known that the day was going to come when they were going to announce a dividend cut. There's no way that a company can be paying basically 100% dividend forever. You know what I mean? That's just not sustainable. So I've always kept that in mind, and always been ready for the day that this might come. Now, with the hangover on forward dividends likely priced in, the risk to reward profile does look enticing, further corroborated by buying sentiments that support its consolidation against ZIM's previous lows in December 2022. If buyers can hang on to the current levels, it augurs well for subsequent recovery, suggesting investors anticipate a more robust recovery in the second half. Hence, while investors may pay close attention to management's commentary on ZIM's upcoming earnings update, significant pessimism has likely already been priced in. Furthermore, ZIM's valuation is still highly attractive relative to peers, rated by Seeking Alpha Quant with an A+ grade. This is the best possible for a Seeking Alpha Quant grade, A+, right? Now, this is our daily chart time frame, all right? And there were plenty of signs that we had a drop coming, okay? Just simply from a technical analysis standpoint. So let me break those down for you guys real quick so you can simply understand them yourself. And start to learn these things and really start to hedge yourself and protect yourself. So we have some circles on the chart, right? Take a look how we're making a high and then a higher high. So the stock is now what's known as in an uptrend, okay? Very clearly, we can see that, right? We're making a low, making a higher low, we're making a higher low, all right? We have a high, we have a higher high, and a higher high. So we're making these higher highs in the price action, okay, and the price of the stock is going up, But if you take a look at your RSI down here, what we can see very clearly is that we have a high and then we have a lower high. At the same point, we had a high and then a higher high. This is a simple term known as bearish divergence, and it happens when the stock price is making higher highs and the RSI, which again measures your relative strength of a stock at its given price. So if the stock is going up, right, you would think that the relative strength index would be going up, right? That's what happened over here when we saw the stock going up. We saw the relative strength index going up. Sometimes there are divergences, and these divergences are key signals of some possible future activity in the price action of the stock. And if you take a look, we did see a very sharp decline afterwards. Okay. And when we tried to rebound and sustain a rally, we entered back into our overhead supply zone, weren't able to break through there, and we did not break through this bearish divergence trend line. Okay. We really need to break through that bearish divergence trend line to have any chance of getting a bullish rally or recovery. Even when ZIM gapped down extremely on its dividend date, we can see that there was a strong rally, but we weren't able to, come back and retest our previous zones because ultimately we didn't break out past this bearish divergence trend line. Now, with earnings coming up, it's going to be very interesting to see, will we be able to break out of here on a good earnings report or possibly good estimates for the future, better than expected, and potentially fill some of these gaps up that we have left to fill here around the $22 to $20 region? Or will this be a negative impact for ZIM, and will we blow through our demand zone here? As we do have a demand zone we've tested many times in the past, right around that $16.50 to about $17 region. If ZIM has bad earnings, then there's a very strong chance we blow through those levels of demand and drop down until we establish some new demand as well. Now, there have been some simple chart patterns to identify and pay attention to. We did trade this cup and handle over here that we had, right? We had a nice cup and handle, and we essentially broke this trend line here. That was the handle for our, cup and handle. We had a nice push up, very nice trade right there. And then we ended up getting a little bit of a head and shoulders. Originally I was tracking for a head and shoulders, but it really ended up turning into more of a double top with a top here and then a top there. Again, you combine that with that bearish divergence trend line that we weren't able to break. And, it was pretty predictable that we saw a big move down. And if you bought put options to hedge yourself against this downwards activity, then, those put options did very well. Okay. There's a pretty significant drop from, $25 all the way down to about $17.50. Pretty sharp move there. Okay. Now, let's use today's sponsor, Simply Wall Street, to dive a little bit more into the fundamentals. And if you guys use the link in the description or the link in the pinned comment below, you can actually get a 14-day free trial and up to 40% off your purchase. Now, we'll go through the platform and show you some of the features of it, but I want you to do is actually look up your favorite stock on Simply Wall Street, okay? It's really amazing and really helps you understand a company a little bit more. Right. So, you can use it to look up ZIM, but you can also use it to look up some of your favorite other companies. Like maybe you want to check out Tesla right now. Tesla's had a really amazing rally, or maybe you want to check out Nvidia. Nvidia had a really amazing rally in this year already. Are these stocks overvalued? Possibly. Should you wait for them to come back down, or is there still value at its current prices? Right. ZIM is the one we're going to take a look at. And when you start off on the platform, it gives you this nice snowflake analysis. It kind of shows you, the strong points of the stock. So we can see the financial health and the dividend are really the strong points of the stock, and the future growth and the past performance and value are a little bit weaker of the areas. Now, right off the bat, they'll go over some of the risks and some of the rewards. All right. And we can see here, from a risk analysis standpoint, earnings are forecast to decline by an average of 135% per year for the next 3 years. That's pretty wild, right? Maybe you would want to dive deeper into that. They do have an unstable dividend track record, and it's very volatile. It has a volatile share price over the past 3 years. Now, from a rewards perspective, the PE ratio is below the US market right now. We'll dive into the PE ratio a little bit more. And if you dive into it, and you take a look at the price to earnings, okay, versus its peers, we can see that ZIM's PE ratio compared to its peers is actually a good value, right? It's at 0.5 and the peer average is 4. So ZIM is a good value based on its price to earnings ratio compared to the peer average. And if you look at the industry average for the PE ratio, which is at 2.7, again, ZIM right here is at 0.5. So it is a good value based on its price to earnings ratio compared to the industry average. Now, as we mentioned before, it is a very volatile stock. And so if you see here, ZIM is more volatile than 75% of US stocks over the past 3 months, typically moving up or down 10% a week. Now, ZIM's weekly volatility has been stable over the past year, but is still higher than 75% of US stocks. So it is very volatile, but it's consistent in being in that volatile range, if that makes sense. It's consistently volatile of about 10% a week, which is pretty extreme, okay, honestly, if you think about it. Now, its next earnings day is May 22nd, 2023. We're recording this over the weekend. That's going to be Monday morning, all right? And you can take a look at some of their previous earnings and data over here. When you look at the key information, got a whopping 96.8% dividend yield right now. The industry average yield is 23.1%. So this is one thing that's really attracted a lot of people to ZIM. But, you know, I've always mentioned that ZIM, there is going to come that day where the dividend is going to get cut. No company is going to be able to pay, 90+% dividend yield for years and years and years, right? It's just not sustainable. It's not going to work. And oftentimes when you see stocks paying these extremely high dividend yields, it's to attract investors and attract new capitalization, bring new money into the stock. So always keep that in mind, right? Now, when you look at the debt to equity ratio, all right, the debt to equity ratio is not bad. It's at 3.2%. And you can dive a little bit more and look at their cash, their equity, their total liabilities, and total assets. It's a really great platform, Simply Wall Street. I definitely like using it. I was proud to, finally get them as a sponsor. I've been using the platform myself for a little while now, and good stuff there. Okay, so smash that like button, subscribe to the channel. Let me know in the comments below your thoughts on ZIM. Is this stock dead now? Is it still pumping? Do you think there's still hope for this, right? Are you guys interested in investing in it? Do you think that other people should be investing in it? Do you think it's time to sell the shares? Let me know your thoughts in the comments below. And if you have any other dividend stocks that you think I should be paying attention to or potentially add to the 50K dividend portfolio and wheel strategy, let me know in the comments below so I can check those out as well. And perhaps I'll even make a video on it just like this one. Don't forget to use the link in that description or the pinned comment below. That way you guys can get a 14-day free trial of Simply Wall Street and up to a 40% discount for the first 100 people that join.